Hey everyone, welcome. Today, we are going to unravel the mystery of the mortgage interest deduction. It's one of the biggest tax breaks out there for homeowners, but the rules got a massive shakeup back in 2017, and what you think you know about it might be costing you a whole lot of money. Let's get right into it.
So let's just imagine for a second. You've got your main home and you've got a nice little vacation spot. You might think, okay, the deduction limit is $750,000, so I get that for each house, right? That adds up to $1.5 million in debt you could deduct the interest on. It seems totally logical. But is that really how it works?
Yeah, that's going to be a hard no. And honestly, it's a super common mistake, a really costly one that can get you into trouble. See, the whole game changed with the Tax Cuts and Jobs Act of 2017, the TCJA. And the new rules, they are way more strict than most people realize.
And just look at this comparison. It really shows you what a huge shift this was. Before the TCJA, you could deduct interest on up to $1 million of your main mortgage, plus another $100,000 in home equity debt. But now, through 2025, that's been slashed down to one single consolidated limit of $750,000, and that's for all your home acquisition debt combined.
So what kind of debt actually counts toward that limit? Well, the IRS has a fancy term for it, acquisition indebtedness. But really, it's just any mortgage you take out to buy, build, or do a major renovation on your main home or a second home. The absolute key, though, is that the loan has to be secured by that specific property.
And here it is. This is the single most important thing to remember from all of this. That $750,000 cap, it's a total limit for you, the taxpayer. It is not a limit per house. So it doesn't matter if you have one mortgage for $1 million or two mortgages for $500,000 each. You can only deduct the interest on the first $750,000 of your total debt, period.
Okay, so the rules for married couples and single filers seem pretty straightforward. But what if you own a home with someone and you're not married? Now this is where the tax code throws us a crazy curveball, one that actually creates a major loophole for some homeowners. And that curveball comes from a really important court case, Voss versus Commissioner. In this case, you had two unmarried domestic partners. They co-owned two homes, and their total mortgage debt was way over the limit. The IRS said, nope, the limit applies to the property. But the court disagreed, and their decision totally flipped the script. The court's logic was actually pretty simple. Tax law applies to the taxpayer, and since each unmarried co-owner is their own separate taxpayer, the court decided that each one gets their own individual debt limit. The IRS fought it, but they lost, and eventually, they had to agree to follow this ruling.
And the result is something people now call a marriage penalty. A married couple filing together, they share one single $750,000 limit. But two unmarried co-owners, they can each take their own limit and stack them, effectively doubling their deductible mortgage debt all the way up to $1.5 million. It's a massive difference, and it all comes down to how you define a taxpayer. All right, now we know the limits, but what actually happens if your total mortgage debt is higher than your cap? You can't just deduct all the interest you paid, so you've got to use a specific formula from the IRS to figure out how much you can actually write off. Let's just walk through a really quick example to see how it works. So imagine a married couple. Their total mortgage debt is $1.5 million. Their debt limit as a couple is $750,000. And let's say over the course of the year, they paid $60,000 in interest. So how much of that $60,000 can they actually deduct? The key is this simple little fraction. First, you take the debt limit, that's $750,000 in our example, and you divide it by your total mortgage debt, which is $1.5 million. That gives you a ratio of 0.5, or, 50%. Then you just multiply the total interest you paid by that percentage. So $60,000 in interest times 50% equals $30,000. That's it. That's their total deductible interest. The other $30,000, it's just considered non-deductible personal interest. It's gone, you can't write it off. So, why are we digging into these rules so much right now? I mean, it's vital to understand them, but there's a bigger reason. This entire system we've just talked about is temporary. We are speeding toward a massive, massive shift in the tax code. You see, all these TCJA rules we've been covering, they have an expiration date. They're only in effect through the end of 2025. Then, on January 1st, 2026, these provisions are scheduled to sunset, which basically means the law is set to automatically snap right back to the way it was before 2018.
And a lot of people are calling this a tax cliff because the changes aren't gradual, they're sudden and they're huge. And it's not just about the mortgage interest deduction. We're talking about dozens of major tax rules all changing at once, affecting pretty much every single taxpayer in the country.
For starters, your income tax rates are scheduled to jump back up. Most of the brackets are going to see an increase. For example, that 22% bracket a lot of people are in, that's going to become 25%. And the top rate will go from 37% all the way up to almost 40%. For millions of people, this is going to mean a tax hike.
And then there's this, the standard deduction. The TCJA nearly doubled it, which was a huge deal. Well, in 2026, it's scheduled to get cut almost in half. This is a massive change because it's going to force millions of people who've been taking the easy standard deduction to go back to the hassle of itemizing their deductions just to save money on their taxes. And that brings us full circle, right back to itemized deductions. The mortgage interest deduction limit is scheduled to pop back up to its old level of $1 million. And at the same time, that super restrictive $10,000 cap on state and local tax deductions, the SALT cap, is set to disappear completely. So the whole tax landscape is about to get scrambled all over again. We're moving from one system to another. One with higher tax rates, but also much more generous deductions for homeowners who itemize. The big takeaway here is that these changes are barreling down the tracks. Being prepared is absolutely everything. So, the real question is, what's your strategy going to be?